to benefit from futures trading. The most important aspect, in my opinion, is to use financial terminals to assist in analysis. Furthermore, the key aspects lie in strategy management, strategy construction, position management, and feedback optimization, which are far more crucial than market fluctuations. Let's start with strategy development. Within the realm of strategies, there are two major categories found in contracts. Many teachers have covered this topic extensively, and I have also taken courses on it, benefiting greatly. The two primary types of strategies are regression strategies and trend strategies. What is a regression strategy? A regression strategy involves setting intervals, such as in the current market situation where Bitcoin is experiencing a volatile trend. You can establish 28,000 as the upper limit of the interval and 26,000 as the lower limit. Whenever the price rebounds to 28,000, you would sell, short, and whenever it falls to 26,000, you would buy, go long. This is called a regression strategy within a specific interval. Or it can also be referred to as following indicators. For example, you can use Bollinger Bands, where you sell whenever the price reaches above the upper band, and you buy whenever the price falls below the lower band. Of course, you can also use other indicators like MACD or ATR for this purpose. So what is a trend strategy? A trend strategy involves taking a position in the direction of a trend whenever a breakout occurs in the market. For example, using the previous range as an example. If the price breaks above 28,000, you would take a long position. Conversely, if it drops below 26,000, you would take a short position. This is what we call a trend strategy. Let me explain the characteristics of these two strategies. In terms of trading, the regression strategy has a relatively high winning rate. This is because people understand that prices, in a financial time series over a certain period, exhibit characteristics of stationarity. Stationarity refers to the property of maintaining stability. And prices that adhere to this property can be considered to follow a normal distribution. Speaking of a normal distribution, it is essentially the inverse representation of it, which is observed in the Bollinger Bands. The Bollinger Bands exhibit a large normal distribution, and a prominent feature is that there is approximately a 95% probability that the prices will oscillate within the interval. In terms of regression strategy, for instance, when it occurs at an extreme position, the lower line of the Bollinger Bands, by default, is set at 2 times the standard deviation. At that position, there is a high probability of reverting back towards the mean. Implementing a regression strategy can yield a relatively high win rate, however. It brings forth a specific issue. Since it operates within a narrow range, the risk-reward ratio tends to be low. For instance, when regressing towards the mean and encountering a consolidation phase after a downward trend, the Bollinger Bands are already narrow. At this point, even if the regression reaches the upper band, the returns are limited. Regression strategies typically have a win rate of around 60% or 70%. In cases where the regression has a high win rate but a low risk-reward ratio, the long-term profitability is determined by multiplying the win rate by the payout ratio, which represents the returns. For example, if the current win rate is 0.8, but the returns can only reach 70%, multiplying 0.8 by 0.7 would result in a loss over the long term. After deducting trading costs, the outcome is generally negative. This illustrates one of the issues with regression strategies. The most typical regression strategy is the grid, and many professional traders dislike it for this reason. The wearing down in a regression strategy is quite high. And although it may appear profitable, the trading costs are also high. Consequently, the long-term profit-loss ratio is very low, and in the long run, it may not be profitable. Then there is another type, which is trend strategy. The win rate of trend strategy is relatively low, and professional traders prefer to use it. These traders who employ trend strategies may only have a win rate of 40% or even 30%, with most of their trades being stopped out. However, this doesn't affect the final profitability. As long as a trend moves in the right direction, it can bring very lucrative returns. Personally, I tend to use trend strategies. In fact, I've observed that these great traders also use trend strategies, so I adopt the same approach when analyzing trades. For example, when the price is trading sideways between 28,000 and 26,000, it is not advisable to place frequent trades. It's better to wait for a clear trend to emerge. For instance, if the price breaks above 28,000, I would open a long position at that level and set a higher take-profit level. Alternatively, if the price drops below 26,000, I would open a short position and set a higher risk-reward ratio. In the long run, this approach may outperform a mean reversion strategy in terms of returns. Next is the selection of the entry position, which can be done in various ways, such as considering short-term resistance and support levels. This involves choosing an entry position based on factors like the upper and lower bands of the Bollinger Bands, or the bullish and bearish crossovers of the MACD indicator. When selecting the entry position, it is important to follow the trend and avoid going against it. Additionally, setting the risk-reward ratio is crucial. I recommend a ratio of 1:3. Which can be easily implemented with CoinWin's platform by directly setting the take-profit and stop-loss levels. The take-profit level should be at least 3 times greater than the stop-loss level. For example, if the stop-loss is set at a 20% loss, the take-profit should be at least a 60% gain. This helps maintain a favorable risk-reward ratio. Afterward, it is advisable to backtest the strategy. You can use PEG Trader or Python libraries for strategy backtesting. If that seems too complex, you can opt for TradingView, which provides a user-friendly visual interface for conducting such tests. What I want to say is that performing strategy backtesting doesn't necessarily mean that the better the backtesting results, the more successful the strategy will be. There is a problem of overfitting. If the strategy fits the historical data too well, it may not necessarily achieve the expected performance when applied to real-time operations in the future. Another important aspect is position management. Essentially, both good market analysis and effective handling and management involve probabilistic actions. It's a repetitive game. Therefore, it is crucial to strictly implement position management. Positions should be set at 1/10 of the total portfolio, and each trade should not exceed 1/10 of the portfolio. Let's consider a scenario. Suppose you have a capital of $10,000. Allocate January 10th TH, which is $1,000, for a main position with a leverage of 20x. Compare this with taking the entire $10,000 and using 2x leverage in full position mode. Which one carries higher risk? In fact, the higher risk lies in full position with low leverage. Therefore, it is recommended to utilize a smaller position with higher leverage for repetitive games. Only through such repetitive games can the strategy effectiveness be observed multiple times. Under the influence of the law of large numbers. Instead of blindly trusting a single instance or relying solely on technical analysis of market trends to develop a strategy, it is important to consider a more localized approach. While success is desirable, failure can significantly impact both position and personal confidence. In summary, the primary objective of engaging in futures is to achieve a stable growth curve and profitability rather than excessively focusing on the return on individual trades. Firstly, it is essential to have a systematic trading system, market analysis, including strategy development, position management, feedback optimization, and so on. Secondly, strict profit-loss ratios should be implemented, and it is crucial to have a diversified investment portfolio. Why emphasize a diversified investment portfolio? Bitcoin and Ethereum are highly correlated, which means that risks cannot be adequately diversified. In serious financial analysis, diversifying risks can reduce risk while increasing returns, providing a free return rate. Therefore, It is necessary to find assets weakly correlated with Bitcoin and achieve a balance in position management. Most tokens are highly correlated with Bitcoin, but there are some with a slightly weaker correlation, such as popular coins in certain sectors. During certain periods, these coins may have independent price movements and may not be highly correlated with Bitcoin. However, it is important to consider their overall liquidity before making a decision and focus on that. Additionally, there are many coins like Surecoin and Dogecoin, which have a weaker correlation with Bitcoin in terms of their inherent characteristics. When placing trades, it's crucial not to only trade Bitcoin but to diversify across other tokens in order to spread the risk. Another aspect is the need for intelligent position management. Essentially, it means achieving stability through repeated engagement with smaller positions, rather than going all in with a single trade. By effectively executing the aforementioned strategies, one can thrive in the market and ultimately chart a favorable trajectory for their financial journey. That's all for my sharing. Thank you, everyone. So, we'll wrap it up here for today. Thank you, CoinW.